Hey everybody, what is up? Let's get set up here. Prof's coming at you. It is Tuesday, May 25th, 2021. Hope everybody is doing well. Glad to be talking to everybody today. Thought I'd kind of start a new series here, maybe. I don't know if series is the right word, but maybe. And talk to you guys about some financial stuff. I don't know if you're like me or not, but I always like to hear other people talking about, their finances and so on. I like to hear like what their financial journey's been like, where they're at on it. So I thought I would share some of mine today. Got a few things I was going to cover. Let me see if I can pull up make sure we are live. I think I see a few people there in the chat. Let me know in the chat if you can hear me okay. What is up, Scott? See you there. So, yeah, we'll make sure that our sound is good and so on. I think it's good. Usually this mic works all right. Can you hear me? Can you hear me? Hello, 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 hello. Yep, looks like you can hear me. All right. So, sound and video are good. Cool, 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 cool. So, as some of you know, we ain't getting any younger. And that means any of us. So if you're like me, well, even if you're not like me, God help you if you're like me. But if you're like me or not like me, you probably have had a lot of thoughts, a lot of concerns, a lot of worrying, a lot of highs, a lot of lows about your finances and kind of what, where you're going with everything. Are you financially secure? Do you have enough money to live, to thrive, to prosper? Are you going to have enough money in the future? And, is your job safe? Do you have enough put away in savings? Is your debt out of control? How's your spending? All these questions that I know all of us has probably asked at one time or another. And as you get older, at least I found, I don't know about you, but I found as I get older, the answers to those questions seem to be more pressing. In other words, you've got less time to figure all that out. When you're 20 years old and you're just starting out maybe, and whatever you're doing, maybe you're starting a business, maybe you work for somebody else, it's not a big deal to think about 40 years from now when you're that young. It seems so far away. It's 2 lifetimes away, literally. And I think when I don't really remember totally being 20 years old. When I was 20, I don't think I thought about retirement. I didn't think about feeling less well. I didn't think about having less energy. I didn't think about not working. I didn't think about not having a stable source of income, all those things. But as I've gotten older, I've realized that all those things are happening. And, a lot of people, a lot of the research I've seen says that once you get in your 50s, those are some of the happiest times in your life. And maybe that's true overall. And it's probably true because a lot of people are sort of reached their peak earning years. They've probably settled into their relationships. They're more stable than maybe they've been. Maybe their kids are out of the home and they're on their way if they've had kids. I don't know. But I found that like approaching 50, as I will be this year, is scary. And it's scary because I realize I can see that I don't have as many years to sort of get all this done as I used to. It's not like I'm 20 or 30 or even 40 anymore. So as I've gotten to that point, it's been kind of worrying me a little bit. And this really started probably back last year, at the beginning of last year. And it really had nothing to do with COVID, I don't think. It really just had to do with, I knew that like I was getting closer and closer to like retirement age, that, I was likely going to have all these things to worry about that I didn't have 10, 20, 30 years ago. and I didn't feel prepared. And to be perfectly honest, I wasn't prepared. I wasn't prepared in any way. So I had to have a really tough conversation with myself and realize that that there's no reason in denying the truth. There's no good that's going to come from trying to fool myself into thinking that I was in better shape than I was. So I started really having a long, hard look at my finances and where I was at, how I'd been doing. And obviously, Kaaren has been a big part of this too. Excuse me. But Kaaren, Kaaren has a little bit different approach, or had a little bit different approach and view than me. So I knew that like anything that I was going to kind of come up with, we had to sort of blend together. But I really wanted to talk about it from my point of view in this video. I was not ready in any way, shape, or form for what's coming in the next 10, 15, 20, 25 years. I just wasn't. And that's being honest. I think a lot of people probably are in similar boats, and maybe you think you are, and maybe you are. And if you are, that's awesome. But if you're not, it's not too late to get started. That's what I'm here to say. It's not too late to make a difference. It's not too late to improve your situation. Matter of fact, it's never too late to do that. But I think a lot of people think they need like decades and decades to sort of get their financial act together. And you really don't. You really can get it together very, very quickly. So I was going to share with all of you kind of what I did and what I have been doing and what I'm continuing to do. So the first step that I had to look at was, where am I financially? And there's a lot of different ways to answer that question, but I think some of the best ways to do it, and this is sort of a Dave Ramsey approach, I suppose, if you're familiar with his baby steps and his formula, but basically it looks like this. Do you have money saved up? Do you know how much money you're bringing in versus how much you're spending? Do you have a plan for the future? And the answer to all three of those things was no. But it really wasn't. Like, I kind of knew how much money I was spending and bringing in. But if you're like me, and like a lot of people, like what happens to a lot of people is you tend to you start making this much money and you spend this much money. And then you make a little more and you spend a little more, and so on and so on. And you never really have anything to fall back on. You never have any sort of cushion, any sort of rainy day fund. And then if you couple that with debt, it's a recipe for disaster. So the first thing I had to realize was that I have a recipe for disaster financially. And the recipe I had was in a few different ways. One, I didn't fully understand my spending and earning power, or my earning. I had debt, credit card debt, car loan debt that was killing me. And I certainly didn't have anything put away for the future. Just reality. There I was sitting there like at 49 years old, 48 years old, I guess, whatever it was. And I had nothing to speak of with all that. And it was for a lot of reasons. It doesn't really matter what your reasons are. Like, I know everybody who listens to these types of videos says, yeah, but this happened to me, and this happened to me, and then this happened. Okay, things happen, but they happen to everybody. They happen to successful people. They happen to not successful people. They happen to everybody. Doesn't matter. You got to find a way to take control of this stuff. So the first thing I did was I started tracking my spending. And what I did was I looked at how much money. It's really simple. If you kind of treat your personal finances like a business, you'll find a lot of success, I think. I looked at how much money I'm bringing in and how much I'm spending. And so how did I do that? Well, most of you probably have a bank account that has online banking. It's really easy to download your bank statements into a spreadsheet, Google Sheet, whatever form you want, CSV, Excel, whatever you use, and then to go through and categorize all your spending. So for instance, I would pull up, I wish I had a good example here for you, but I don't know that I do. Maybe I do. I'll try to see if I can find one. I would pull up basically all of my, I would pull up all of my spending, and then in the column beside it, I would go through and code each thing. And I would just make it really simple things. I would code it. Let me see if I've got like a monthly download thing here that's not going to like give away the whole farm. I would just code like the types of spending that I had. Like, all right, this was dining. This was groceries. This was gas for the car. This was rent. This was, insurance. This was a tax expense. This was credit card payments, what have you. And I just did that in one column all the way down. And basically that kind of allowed me to sort of start aggregating those together and figuring out where I was spending my money. And let me see if I can pull this up. Basically, when I started doing this back last year, I realized very quickly that I wasn't really, I started adding it all up. I had like, you guys have probably seen a basic, personal, like a personal budget template that looks, let's see if I can pull one up here that looks kind of reasonable for everybody. Yeah, let me see if I can pull this one up. It'll look something like this. Let's see if I can share this. Gosh, I got to remember how to add this. How do I add the settings here, or add another page? Share screen. There we go. Yeah, so it looks like this. So you can see you got a lot of different, I'm going to make that full screen for a moment. It looks something like this. You've got a bunch of different columns here by month, January, February, March. This is exactly what I did. And then you got like, you put in your revenue, you put in your income, your job. Maybe you have rental income from a property you own. Maybe you have a side hustle, maybe your eBay, maybe your Amazon. You put that in. And then you add all that up. And then you add up all your expenses: rent, electric, natural, water, sewer, waste disposal, car payment, every single thing. You're going to want to do every single thing. Don't leave anything out, no matter how small. And remember, you coded all these over with your statements. And you can, it's not hard to write a code to go in and tell it, all right, everything that's electric in the month of January, sum it all up and put it right here. That's not hard to sort of figure out, but it's beyond the scope of this video. And then you're going to sum all those expenses up, and then you subtract out your expenses from your income, and hopefully there's some net, excuse me, hopefully there's some net income. If there's not, then you're spending more than you're making. Now, let me just say that for a lot of people, when they do that exercise I just did, they find that they're spending more than they're making. Now, that seems kind of counterintuitive, like, well, how is that possible? Well, maybe they had some money put away, so they're dipping into that every month. Maybe they're financing their lifestyle on credit, which is the second section I wanted to talk with you about. I had credit cards. When I started this journey last year, I had 6 credit cards. And that, off the top of my head, I didn't have huge balances, but they were big enough. I want to say I was around $15,000 between those 6. And I realized that what I was doing was exactly what I just said. This amount was coming in, but this amount needed to go out each month, or I was spending. And so what I was doing is I was putting that money on credit. So it's like, oh, well, I'm $200 short this month. I'll just pay for this with this credit card, and then just pay off, $25 next month or whenever the bill comes in. But then interest is adding on, and you're getting further and further in debt when you're doing that, and you're not really finding a way out. So the first step you must do, I think, is what I did, is you have to be honest about what you're spending and what you're making, and you need to see it and you need to track it. If you don't put it down in black and white, you can put it on a piece of paper if you want, a columnar pad, your own spreadsheet, whatever. There's a million of these budget templates out here. Do it. Start tracking everything. Do it for 30 days. Do it for 60 days. And that alone is going to start opening your eyes to where your money is going. Because it can be surprising where it's going sometimes. Because some of these expenses, you know, going back to this for a moment, let's see if I can get this back up. Going back to this for a moment, some of these expenses over here, you can see like, you know, rent. I'm gonna blow this up a little bit. That's a little better. You can see like rent is going to be the same amount each month, probably, or mortgage. Your car payment is probably going to be the same each month. Now, car repairs is going to be variable, but you're going to have car repairs, right? Maybe you got a warranty, maybe you don't, but even there, it doesn't cover everything. It doesn't cover things like brakes and tires sometimes. Car insurance is probably going to be the same for 6 months at a time or a year at a time. Your gas bill is going to be variable. Your phone should be roughly the same, or cell phone. You might just only have one. Internet's probably going to be the same. Clothes is variable. Like, it's important to realize some of these expenses you control how much you spend on them, and others are going to be the same every single month. Now, you can also control those, but once you've already committed to a rent or mortgage, you're basically stuck with it for a while. So, let's see. Let's go off of that. All right. So basically, you need to do that I would do it every single month until you get a handle on what you're bringing in, what you're spending. And like I said, if you're spending more than you're bringing in, you need to make a couple hard decisions. You got a few options there, and they're not all exclusive. If you are spending more money than you're bringing in, you can make more money, or you can spend less, or you can do both. And I would argue you should probably try to do both for all kinds of obvious reasons, I think, because if you're making more, you're not going to have as hard a time, you know, getting by with everything you're trying to do. And if you're spending less, it's going to put more money in your pocket. So I did that and realized I was spending more than I was making. But that wasn't enough just to like identify the problem. Like, I literally had to start doing something about it. One of the things that I realized I needed to do something about was credit card debt. So I was spending about $375 a month on credit card payments. Now, that's not crazy compared to some people, but it's still a lot. That's like over $4,000 a year just on credit card payments. And by the way, that was just the minimum payments. So minimum payments, for those of you who don't know, don't bring your balance down very much, very, very minimally. So you end up paying a lot of interest on that. You know, a lot of credit cards will set up their minimum payment to be about 1 to 1.5% of your balance each month. But, you know, 3/4 of that can be going to interest. So you're not even really making much headway on the debt. So I made what I think was probably one of the smartest decisions. And this is the one I think everybody listening, I think you should do this if you have credit cards and you have debt, you should do this. And you're spending more than you make. You should close those credit cards and cut them up, be done with them. Because it's too much temptation if they're laying around. Even if you say, well, I'm not going to use it. Well, why are you keeping it? If it's not something you really need, why do you have it? Why do you have it there, you know, tempting you? And I know a lot of people are going to say, you know, well, you know, I want a good credit score and I earn points and yada, yada, yada. That may all be true. But if you are spending more money each month than you're bringing in, or you're very, very close, maybe you're right at 100%, those credit cards are a temptation. They're not an emergency fund. That's a misnomer. They're an incredibly expensive way to borrow money, credit cards. Even for people with good credit, it's still an expensive way to borrow money. So it's better, I think, to do what most people would recommend is you just get rid of them. Get rid of them for a while. You can always get them back in the future if something happens. But and as far as your credit score, we can talk about that separately. But, you know, that's kind of one of those things, too, that people get really hung up on. And it's because you've been told kind of a lie from the financial institutions that you need to have a good credit score. Well, let's examine what a credit score really is. This is kind of one of the things that's really hit me over the last couple of years. A credit score means you're really good at paying money back to banks. That's all it is. That's all it is. It's not some sort of, you know, dissertation on what type of person you are. It's not some life goal I think you should strive for, because to gain a great credit score, you must borrow money and pay it back. That's the reality. That's how you get a great credit score. You don't get it just because you exist. So I just think that when it comes to, you know, paying banks back money, and that's some sort of way that you're determining your self-worth, I think it's silly. I think it's dangerous. All the research shows that when people have, even with people who use their credit cards for points, yada, yada, they show that people who use credit cards for a lot of spending typically spend more. So if you think about it, like if let's say you're getting 1.5 points back on everything you spend. Well, if you're spending 2% more, you're still going in the hole. You're spending more than you're getting back. So those points aren't really helping you. I just think that credit cards in general are a bad idea for most people. Actually, I think they're a bad idea, period. They're just an expensive way to borrow money, and there just isn't a lot of really good reason to have them, in my opinion. But that's a topic for another video. So I got rid of mine. That way I was not tempted, and that way I could really get to work on paying down those balances without the temptation of spending more money. And the third thing I need to do was to kind of look at my net worth. And this is one of those things where a lot of people, you know, I probably haven't updated this like I should. A lot of people will tell you need to, you know what your net worth is, because you need to know, like, are you kind of making progress on things? So what I did was I started tracking my net worth. And your net worth is simply, let me see if I can pull up a good description of it. I love just pulling up an image of something instead of pulling up the actual thing. Oh, here's a good one. This should be nice. Let's see if I can pull this up. Oh, it's from NerdWallet. Well, I do enjoy NerdWallet. All right. So net worth, for those of you who don't know that term, or maybe you've heard the term and wasn't sure exactly what it means, it comes from accounting, and it basically just means your assets minus your liabilities. And these are assets over here: checking, savings accounts, retirement accounts, real estate, autos, things that are worth something, right, that have value. And then over here is your liabilities. So your consumer debt, your personal loans, student loans, mortgages, auto loans, and other debt. So anything that you owe. So if you think about that, you got over here what your money, everything that's, you know, worth something, and over here everything that you borrow to get it, probably. You want this one, the assets, to be higher than the liabilities. And if you do that, then you have a positive net worth. If the liabilities are higher than the assets, then you have a negative net worth. Net worth is actually real wealth. Money in the bank is not really wealth per se. Rich people aren't necessarily wealthy. You may have $100,000 in the bank. You may have $1 million in the bank. But if you have $1,100,000 of liabilities, you actually have a negative net worth. You owe more than you are worth. So you really want to be working on increasing that net worth. And one of the ways you do that is you get rid of debt, because debt is a liability. It takes away from your net worth. And that's kind of what I did with the credit cards. It's also what I do with other things. I said, you know what? I've got a car. I'm going to get rid of these credit cards. I'm not going to go in any other kind of debt over the next year or two. I'm just not going to do it. I don't care what it is. If I can't pay for it straight up, I'm not doing it. I'm not buying it. So that was part of the equation too. So I look to start increasing my assets. So I've got controlling my spending. How much am I bringing in versus how much am I spending? I'm looking at getting rid of the temptation to, spend money on credit cards by getting rid of the credit cards, not going into any more debt, and looking to improve my net worth. And, when I started this whole process back in April of last year, my net worth was, my assets minus my liabilities was about $42,000 to the negative. Now, the average American has a positive net worth, but that's mainly because of their home. And your home is an asset, but it's also a liability if you have a mortgage on it. And then there's a difference in the price, the difference in what it's worth versus what you owe. And usually that's a big chunk of money. But a lot of people don't have a very high positive net worth if you take their home out of the equation. And it's not easy to take your home out of the equation because you need somewhere to live. So I think including your home in your net worth calculation is a little misleading. It's great. If you have your home free and clear, knock yourself out. But if you owe money on your home, if you owe a mortgage, I would almost be tempted, and especially if the mortgage is like you're kind of upside down on it. Like, let's say you owe 210 and it's only worth 200. Like, it's actually hurting your net worth. So homes are kind of tricky to figure in this, but everything else, cash, investments, retirement accounts, those all count. Your any sort of collectibles or anything like that you own, those are all good assets. And then the debt on the debt side, it's all the stuff we already know. It's credit cards. It's maybe you owe a tax debt. Maybe you owe student loans. Maybe you owe, mortgage. You owe on your car. Those are all debts. And when I did all this, I was at 42,000 to the bad. And that was depressing. I'll be perfectly honest with you. That was kind of depressing. It was depressing and it was embarrassing. And it made me kind of mad because, excuse me, this was April of last year. I realized at that moment, like, I had failed to be financially responsible. And, nobody likes to fail at anything. So I had a couple choices there. I could have kept going like I was going. And, 50 would come and 55 and 60 and 65. And, I would be in worse and worse shape, or at least as worse, as bad. Or I could do something about it. And I decided I was going to really do something about this. So I committed to myself. Like I said, I committed to myself to control the spending, spend less than I make each month. I started putting money aside in my savings. And I said, you know what? First, I'm going to try to save the $1,000. Again, a Ramsey baby step, which is great. Because, $1,000, if you can save $1,000 and just put it aside for if just emergency, like let's say you drive to and from your job and the transmission drops out of your car, that $1,000 is going to come in handy. Now you should try to be saving for, car repair the best you can. That should be a budget item, but that $1,000 gives you a little bit of security. And then I resolved to get myself out of debt. And the only debt I still have, and I'll share with you my changes in net worth here in a moment, is the car. Because I did pay off the credit card. I went aggressively after them. Like if the minimum payment was $150, I sent them 200 or 250. I was like, you know what? I'm getting out from under this stupid debt. And, I went from 6 credit cards to 5 to 4 to 3. And to finally, back at the end of last year, I got rid of the last one. I really went aggressively at that $15,000. And, because if I had not paid it, that $15,000 would end up costing me $30,000 if I had just kept paying minimum payments. So it's like, what am I doing here? Am I going to get serious about this or not? And I decided I was going to be serious. And then I started funding not just $1,000. I was able to get there, but also more, because, you're going to have the rainy days are going to come, and you're going to need a few months of living expenses, maybe 3, maybe 6, maybe even a year. So I've been saving up for that too. And that's still a process I'm continuing to save towards. I also started investing in a couple different areas. I invested in my retirement at work when I was at Amazon, a dividend portfolio, and as well as an IRA through a Vanguard, a Roth IRA. And it's made a huge difference, guys. I feel differently about money now. That's the one thing that's changed, because in the past, money was always such a source of stress. How am I going to rob Peter to pay Paul this month? I mean, has anybody else been there in the chat? Have you felt that way? I felt that way, like, well, bills this month are this, but income is only here. So how am I going to do that? And then you end up putting something off or really trying to space something out, but you're kind of getting further and further behind. And I didn't want to keep feeling that way. And I knew that it was going to take a lot of sacrifice over the 12 months, 18 months. And it's going to take some continued sacrifice. I'm not done. But it's really made a huge difference. Excuse me. And I was able to knock that debt out. I was able to knock out, a lot of the other, we got, as many of you know, a lot of us got stimulus money last year, stimulus payments from the government. As soon as I saw that money, I thought, I'm not buying something. I'm paying off debt. I'm putting money in savings. And that's exactly what I did. I think that you have to, when you get a windfall, it's important. Use that to go towards your goals. Your goal shouldn't be to buy, a new computer. Your goal shouldn't be to buy Tesla. Your goal should be to be financially sound. And that looks like getting rid of the debt, saving up at least 3 to 6 months of living expenses, depending on your situation, and investing. And why? And then you got to ask yourself, well, why are you doing all this? Well, there's something at the end of this, right? You're not saving up all this money so you can just sit there and collect it till you die. I think you have a responsibility to give back. You have a responsibility to provide for your family, provide for your friends, provide for your community, and to do great things with the fortune you found, and to share the fortune and also share the knowledge to get there. There's a lot of kids today that go through high school, maybe they go into college, trade school, what have you, and they never learn about money. They just don't. They don't learn it from their parents. They don't learn it from their friends. They don't learn it from their school. And then they reach a point where they're like 20, 25, whatever, and now they're in debt. And now they're spending more than they're making. And they have nothing put away, and they're getting further behind. If you know someone like that and you've walked a better financial journey, share it with them. I think that's important. Kaaren and I have really been trying to impress upon Ben, her son, the lessons we've learned the hard way. And you know what? He has took heed. He is making decisions right now that are going to make him financially fit for life. And I think that is such an amazing gift to give to a young person. So they don't get saddled with debt and obligation and stress around money and so on. Like, there's no reason for that for a lot of people. And yes, I know there's people out there who are scraping to barely make ends meet, and they have a different set of circumstances. Everybody's got their own particular challenges and crosses to bear, so to speak. But if you can help somebody, especially a younger person, so they don't make these mistakes, so they don't wake up at 50 and realize, oh my God, I'm in trouble. I'm running out of time. So that's what we're doing. And that's what I've been doing for the last year, because there's no better time to figure out your finances than right now. It's not going to get better in the future or worse in the future necessarily. Right now is the best time to do it. If you're behind, you can, if you're in debt, work to get out. If you're not making enough to meet all your obligations, I don't mean your wants, your needs, then look for other ways to make income. Look for side hustles and look for ways to reduce your expenses if you can. Make a commitment to change your mindset around money. Because one thing that's amazing about, most of the people watching this broadcast are probably in the United States. There are so many ways now to improve your income and improve your standard of living that it's much easier than it was in the past. It's much easier to have side hustles and businesses and start, your own company and all kinds of things you can do, big and small. So there's not really any excuse to say there's a lack of opportunity, because there really isn't. There's a lack of motivation. There's a lack of follow through. There's a lack of commitment. There's a lack of desire. And there's a lack of understanding of what will happen if you don't. Those are things that you have to have internally to succeed. And we all struggle with them. I know I've struggled with them many, many times. I still struggle with them. So I just want to share with you kind of where I got to. So after this past year, I kind of skipped a few months in my personal net worth journey here, because Kaaren and I merged our net worth together. But I put in sort of the final total. So if you remember, I told you I was at minus, what was the total? Minus $42,529 on April 1st, 2020. So since then, in all the ways that I've been working to get that down, let me show you the difference. So my net worth went from, you can see down here, this is minus, I don't know how well you can see it, minus 42,529, all the way up to now, the end of April, is up to positive $16,791. So that's about a $60,000 turnaround. And that hasn't been easy. It's broken out over here. You can see I do still have about $12,000 I owe on the car, $12,500. But I don't owe any tax debt, no student loan debt, and no consumer finance debt. Over here, you can see in cash equivalents around $11,800. Some other assets that I own around $7,400, some investments and retirement accounts. Now, the retirement accounts are pretty low. So we're working on that. But, if you're dedicated, even in just a year's time, you can really make a big difference. And I'm curious where this number is going to be next year, a year from now. I think it's going to be even higher. I think it's going to be 50,000. It's going to be 70,000. I don't know yet. But I'm excited to kind of build it, because I'm going to keep pumping money into this cash, assets, investments, and accounts and so on, and just avoiding this. And that's really what it is, gang. It's just you have to be committed to it. You have to be committed to improving your situation, and you can do it. And like I said, I skipped a few months here of tracking only because Kaaren and I kind of merged ours together. But I just really went at it. I put every penny I could into it. And, if I improve my wealth again, $60,000 this year, it'll be around 75K, which is not bad from starting from zero. And I don't have a house. So this is no real estate owned in this net worth. But I just wanted to share that with you guys so you would know kind of what was possible. But, I know that I've probably got a good 10, 12, 15 years of decent work left in me. That's the right term. So I need to do it kind of now, but I would say that like your job, if your job pays you really well and allows you to get ahead and really contribute to your net worth, great. But a lot of people's job doesn't. And partly, sometimes because they've spent up to like the level of what they're making, but sometimes it's just the job doesn't pay enough. It's just, it pays enough for their needs, but it doesn't give you any cushion or any extra. Get a different job, get a second job, get a side hustle, start a business, and start that climb. I mean, you want to see that arrow going up and to the right. It's kind of, I have to do it backwards here so it'll look right for you guys. I think that's doable for everybody to some degree. And you know what? My steps, my progress doesn't look that impressive compared to some people online. I know it doesn't. I've seen the videos, I've seen the Instagram posts, but it's impressive to me because if I wouldn't have taken action, I would have still been down there, with no money to my name. And if I showed you like what my assets were in the beginning of 2020, the beginning of April of 2020, that cash on hand was probably like $200. I'm not even kidding. There was no retirement account. There were no other investments. There were no other assets. So, I just think that like, you got to start somewhere. And, I had a lot of missteps along the way over the last 10, 15 years for various reasons. Well, for one reason, me. I was the reason. There's nobody else to blame. There's no, there's no really good excuses for this. You need to, in my opinion, you need to own it. Nobody else is going to own your financial success. You have to own it. And it's hard. Don't get me wrong, but it's also worth it because what's the alternative? Financial failure? That's really hard. That comes with a crazy cost to people. So, I didn't know exactly all the reasons I was making this video, as typically as my videos go. But I think if I had to boil it down, I would just say, if your finances are not where they need to be, whether you're 50, you're 40, you're 30, you're 20, start now. You can start like right now. There's no reason to wait. There's no better time to start than right now. Start today. Start tracking your spending. Make a budget for everything. Avoid credit card debt. Avoid spending on anything frivolous. Look for other ways to bring in income. Get a second job. Get a different job if you need to. Get a side hustle. Start a business. Start putting away cash. Pay off all your debts. All of them. All of them. I like the Ramsey snowball method, which is where you pay your smallest debt first, like the smallest balance. Now, sometimes that's not the highest interest rate, and technically you'll pay some more interest by doing it this way. Mathematically, the best way to pay off your debts, if you want to save the most money, is pay the one with the highest interest rate first. But in my case, the one with the highest interest rate also had the highest balance. It would have taken me forever to pay that dang thing off. So it's kind of nice sometimes to pay off the small ones and get some wins under your belt. Like feel good, like that bill's gone. All right, $5,000 over here at 19% interest and only $1,000 over here at 14% interest. Mathematically, you should pay off the 19% interest first, but the 1,000 one you could probably pay off a lot quicker, and you'll get a win under your belt, and you'll feel good, and you'll get momentum. You'll be like, it's gone, it's done. I don't have to send them any more money. Done, final, complete. Don't bug me anymore. Send me no more notices. That worked for me. I think it works for a lot of people. I think that debt snowball method. And then the next month you roll that payment you were sending to the $1,000 one into the $5,000 payment one. So you pay the minimum payments on all of them except for maybe one. And then that one, you just put everything into it you can. And then once you're done with that one, then take the next smallest and put all the payment from the one you just paid off and the payment you were paying in the second smallest, and then put it on that one, and then just keep going up the ladder until you've got them all gone. I love that method. I think for me, that is the best way to do it. I think that's the best way for a lot of people to do it, even though you will pay a little more interest mathematically. If your lowest balances aren't your highest interest rates, but you got to get wins, gang. I mean, you got to get momentum. You got to get moving in the right direction. And it's so good when you send that final payment in and you're like, done, no more. Such a good feeling. Check it off. Take it off of the debt part of your balance of your net worth. And, it's just a great win. So anyway, I wanted to share all that with you. Hopefully it's helpful. I'm always interested in talking with finances about people, and there's a lot more I could say about a lot of those subjects, but I wanted to kind of give an overview of where I was and just kind of see where people are at here in the chat. Let's see. Scott said he's a few years older, and I totally relate to what you're saying. Yeah, I mean, and it doesn't matter where we start, does it, Scott? I mean, you just start with where you're at. If you're starting early and young, congratulations. If you do this when you're early and young and you start investing and you start putting money away, you got a real good shot of being a millionaire. And by the way, when I say a millionaire, I mean somebody who's actually worth $1 million. Doesn't have $1 million, is worth it. Their net worth is over $1 million. And the reason is because you got time on your side then to compound on rates of return, and you've got earning, so Emperor says, I do this about once every 12 months, and then the depression lasts 11 months until I do it again. That's honest. Well, Emperor, I would ask, why is it depressing? Maybe you still haven't come to terms with it yet. Maybe you still haven't come to terms with where you're at. And that's very typical of most people. It was typical of me for a long time, like a lot of years. I mean, it was typical of me for years. This wasn't like this happened overnight. But if it's making you upset, then, ask yourself, well, why is it making me upset? Well, maybe it's making you upset because you haven't gotten a handle on it yet. You can do that. You can do it. Take a small step. Take a small step today, tomorrow, and then take another one the next day, and then another one. And before you know it, you'll be there. So, don't give up on that. Sue, what's up, Sue, says the home equity is not easily accessible. Yeah, exactly. Right. I mean, it's really not. You have to sell your home to get it. Joni, I don't know if I'm saying that, Joni or Johnny J says there's a reason Dave Ramsey's popular. Things you should learn from grandma. Stop falling for all the hype and plus points. I agree. And I argue this with a friend of mine all the time about points. And I wish he was here in the chat, but he's not right now. And I will let him stay nameless for the moment. But Sue probably knows who he is. Yeah, I mean, the points, that's a marketing tool that the credit card companies use. Let's be honest, it is. One of Ramsey's big things he rails against is timeshares. And they sell timeshares on the basis of like, look, you're going to own this building for 2 weeks a year or whatever it is, and you can go there and take vacation. And what you find is when you do that, people on average, even people who own timeshares for decades, only go a handful of times. So they end up paying, $20,000 for 6 nights at a very expensive hotel, i.e. their timeshare. So it's not really worth it. And points are kind of the same way. Like, are you really going to go stay in all those hotels for those points? Are you really going to take all those flights? Like when? Like most people can't just go on vacation every other month. So I get it to a point. Like there are some people that it probably makes sense for because they travel quite a bit. And if you do, maybe points makes a little bit of sense. But the pitfalls are quite quite steep if you're not careful. Joel says, I admire your honesty. Most people are underwater on assets and liabilities. The sooner we face it, the better we all be. I agree, Joel. Time is on your side if you act quickly. I mean, time just, so act now and you can get your situation better. Let's see. CT Coburn says, how are you accounting for inventory you have? Sorry if you already covered that. Now, let me be very clear here, CT Coburn. That's a great question, by the way. This does not have anything to do with my business. Nada. Because my business is a corporation and it has its own separate accounting, its own separate bank accounts, its own separate spending, its own separate expenses, its own separate profit. Yes, I pay myself a salary out of it, which obviously flows into, all these numbers I just share with you, but the business does not. This is not the business's numbers. That's a whole different thing. And if you're if you're in business for yourself, you probably already know that, like, you have to keep those things separate. There's lots of reasons to keep them separate, but you can't conflate the business's finances with your own. That actually can cause you problems with your tax returns and so on, and being able to claim things for deductions and so on. So be very cautious of that. And I definitely do not. Like, I separate them. They've been separated from day one. Do you have any exposure to cryptocurrency? I do not. I recently posted on my Instagram, which there'll be a link to that in this video, about how I don't think cryptocurrency is the right investment for most people. It's not the right one for me, and I don't think it's right for most people. And really, the reasoning came down to this, Mr. Cortez Alex. With traditional companies and traditional indexes, even ETFs to a large extent, you have a way to figure out the valuation of the company or companies involved in those investment vehicles. And then you have a way to look at their price versus their earnings versus their shares outstanding versus their market capitalization versus there's all kinds of different financial ratios out there for technical and fundamental analysis that can give you an idea about whether or not you should invest in something. And what determines whether or not you should invest in something? Well, largely price, not entirely, but when you invest in something, you're hoping that the price will move in the direction you want it to move in. Could be up or down. If you're shorting, you want it to go down. But this is not always just up. But no matter what, you need to be able to understand, in my mind, if the price of something you're investing in is a good price at that time for the strategy you're choosing. I don't know how to value cryptocurrency. And I don't think anyone does. And the reason is, you can't tell me, or no one can tell you, is Litecoin at a good price right now, or Ethereum, or, Bitcoin, any of them, because there's no underlying company. There's just fluctuations in the market. And we've seen some wild fluctuations in Bitcoin. For instance, the most well-known coin, just in the last 3 weeks, it's hit an all-time high and then dropped 50% in 2 weeks. Was it too high before? Is it too low now? What's the future for it? I don't think anybody knows. I think it's all just pure speculation at this point, because it's a very immature market. And that's immature in the sense that it's just not old. It doesn't have a track record yet. I read this story the other day about a guy who he bought a lot of Bitcoin like in 2010, maybe. I don't remember. It was not long after it had come out. And then he figured it wasn't really going to be worth a whole lot. So he started buying pizzas with his Bitcoin. And he spent about $400 worth of Bitcoin at the time on pizza. And today, those Bitcoins would be worth hundreds of millions of dollars. So, if he had kept them, like, he spent like thousands of Bitcoin on pizza back, 11 years ago, back when Bitcoin wasn't worth anything. So clearly he didn't think it was really going to be, he bought it because he thought it was cool, maybe a novelty, but he had no idea that a decade later it would be, he would be a very rich person if he'd have held on to that. Nobody knew. And nobody knows today. You can look at traditional companies today and you can look at all those factors and you can make some educated guesses about where price is likely to go. Now, it's not perfect, and things can happen that can surprise you. I was looking at dividends for one of our dividend stocks the other day for one of our portfolios, and I was looking at the company Clorox. And if you look at Clorox is an older company. They've been around for a long time. They've paid dividends for a long time. They've increased dividends for many, many years. Clorox kind of did this, like a nice steady. And then last year it did this. It jumped way up. But then since then it's dropped back down about 25% off of its 52-week high. Why? Because Clorox became very, very in demand and popular during the coronavirus pandemic. Nobody could have predicted that. Like, that was a temporary price increase. But now it's come back down more around the price that it probably really should trade at. Bitcoin and cryptocurrencies and so on, they have those sort of spikes every day. Like, sometimes in a day or two, they can jump that high for no reason. Or like Elon Musk says something, or someone at the Treasury Department says something, or China cracks down on crypto. Like, it's crazy swings. And as an investor, I don't have any way to figure out if it's a good investment or not. That's just really what it came down to. So I just have to stay away from it at this time. Not saying I'll always stay away from it. To me, any money you put in cryptocurrency at this point is pure speculation, because there's no telling. I remember this happened 4 years ago, and price jumped up to nearly 20,000, and then it dropped back down to like 3,500 within a year. I mean, it's just what it does, so nothing really surprises you with it. But as a long-term investment, I don't think we know what's going to happen with regulation. I don't think we know what's going to happen with governments and banking as they try to deal with this. I don't think we know what's going to happen with security, cybersecurity around these currencies. I just don't think anybody knows. So that's a long answer, but I want it to be thorough because I know there's a lot of people who are interested in it. A couple more things and I'll jump off here. If you're a couple, Duncan says, if you're a couple and one of you has a job and the other runs a home business, that works well. I agree, Duncan. I just realized my hair looks really bad. Sorry, guys. Sorry to disturb you with it's not bedhead. I swear too funny. Lori says, congrats on your progress. Good to hear and see you. Thanks, Lori. That's very nice. Good to see you too. Johnny says, most people are too busy trying to pay for the timeshare and don't have time for the vacay. Yeah, that's another problem with timeshares. Like, they're expensive. When we were looking at beachfront property, we saw that. Like, we saw a house that was like $60,000 on the beach. And then I'm looking and it was really nice. And then I realized it was $60,000 for 1 week. So you got it 1 week a year. That was it. Basically a timeshare that they weren't calling a timeshare, but I'm like, it's basically a $3 million house that you're renting for a week for $60K. So Richard says, I make around $500 a month on cash back for credit card points via my business. I then use this to pay down my car faster. Yeah, well, and I hear you, Richard. I would just caution you to be careful to keep, like, if you're using a credit card for your business and then you're using, that cash back to pay on your cards, make sure those are separate things, because, it gets a little tricky there and you start mixing your business expenses with your personal spending. Talk to an accountant, talk to a financial professional, but those can raise some red flags if you ever got audited and so on, and they can start disallowing deductions, and you just got to be careful of that. Maybe you already have, and if you have, that's cool. Yeah, and I think with the points in general, Richard, business is a little different, I suppose, because if you're consistently ordering inventory, Maybe it makes sense. We're actually looking at the M1 Finance spend account right now to maybe change some of our banking because they offer a 1% APY, which is far greater than any bank right now. I'll try to put a link to M1 down there in the bottom. I'm going to be sharing our dividend portfolio very soon, and it's going to be pretty cool what we're doing, I think. So you guys will get to see that. But it has a 1% APY and a 1% cash back as well. So we were thinking about using that for just our personal spending. But I just think that in general, points can really, like, I think if you have points with like your account, that's fine. But if you have points with like a credit card, the temptation to not pay that off 1 month, the first month something goes a little wacky, you know, you take a little bit of an income hit, and now all of a sudden you're, you know, now you got $1,000 balance, you know, that's going to cost you every month. You know, I don't know. I just think it's really risky for most people. I don't think most people benefit from the points, and they definitely spend more money on average, as all the research has shown. So by the time you factor in the spending, you offset what the points were. You know, so I don't know if you heard that earlier, Rich, when we talked about that, but a lot of points pay you back 1 point or 1.5%, but a lot of people spend, excuse me, you know, an extra 2 or 3% when they use credit cards in general. So you end up not really getting anything for it. But maybe one more thing here, and then we're going to call it. Let's see. Ask Scott says, so did I miss the numbers? Yeah, you'll have to scroll back, Scott. I did share several numbers. I understand your actions with your previous employer. I too would do the same, maybe quicker. I think you did the right thing for all that encompasses. Yeah, I appreciate that, Scott. I've had several people reach out to me about, you know, the conditions under which I left Amazon and the reasons why I left it. And I'm happy with it. As I mentioned in that last video I did, I think Amazon's a great place to work. I don't have negative things to say about Amazon. Was everything perfect? Of course it wasn't. So was I perfect as an employee? Of course I was. But it just reached a point where I understood once again why working in corporate America is not for me. So, all right. Thanks everybody for joining. If you haven't subscribed to my channel, please click the subscribe button before you leave, and hit the like button and leave a comment if you want. I like hearing from people. I do review all comments before I post them. So if you don't see it right away, that's why. But I really do like hearing from people and interacting with each other, with everybody. So thanks for hanging out. Look for some more videos coming up on finances, reselling, all this good stuff really soon. And thanks for hanging out with me, guys. I appreciate it. And I'll see you all soon. Take care.